Hey there, future CMAs. I am so incredibly glad you're joining me today. Welcome to our Expense Analysis Masterclass. You know, over the years, I've watched countless students tackle this exact syllabus, and I can tell you firsthand, while managing revenue and cost of sales is definitely your starting point, expense analysis is where strategic financial leaders really shine. It's how they separate true operational efficiency from all that hidden corporate waste. So, my goal for today's explainer is simple. We're going to demystify profitability analysis together, step by step, so you walk into that exam room feeling absolutely prepared and totally confident. Let's get into it.
Here is our game plan for today. We'll start by looking at the profitability big picture. Then, we'll get into categorizing operating expenses, followed by cost behavior and leverage. After that, we'll tackle a real CMA practice scenario with Horizon Corp, and finally, I'll send you off with 3 golden exam roles.
All right, part 1, the profitability big picture. When a company wants to boost its bottom line, almost everyone's first instinct is, hey, we need to increase sales. But let's be real, increasing sales is notoriously tough, and it's usually pretty expensive to pull off. Controlling operating expenses, on the other hand, that means every single dollar you save drops straight down to operating income, no filter. So, to set a really firm baseline for us today, we are not talking about cost of goods sold right now. We're zooming entirely in on operating expenses. We're talking about your selling, general, and administrative expenses, or SG&A, along with research and development. Keeping these clearly separated on the income statement is absolutely crucial if we want to evaluate a company's true operational efficiency. Now listen closely, because the ICMA is definitely going to test your ability to evaluate these expense structures. You have to be ready to answer 3 very specific strategic questions. First up, how efficiently is management actually controlling overhead relative to their revenue growth? Second, how does the current cost structure magnify earnings risk if the economy takes a downturn? And third, and this is a big one, are expenses being improperly capitalized or deferred just to artificially inflate current profits? Keep these 3 anchor questions in the back of your mind as we go through the rest of this material. Moving right along to part 2, categorizing operating expenses. Okay, before we can analyze any data, we have to organize it, right? We do this by grouping our expenses into functional categories. First, you've got selling expenses. These are your frontline costs, directly tied to actually generating sales. Think sales commissions, advertising campaigns, storefront rent, delivery costs, things like that. Then, on the other side, we have general and administrative expenses, or G&A. This is your back office corporate overhead. We're talking executive salaries, legal fees, IT infrastructure, and the rent for your corporate headquarters. When it comes to evaluating profitability, the ICMA relies heavily on vertical common size analysis. And the workhorse formula you absolutely need to know here is the SG&A expense ratio. It's super straightforward. It's literally just taking your total SG&A expenses and dividing them by your net sales revenue. We use this ratio to figure out exactly what chunk of our sales is just being swallowed up by operational overhead. So what does this actually look like when you're sitting there taking the exam? Well, let's contrast a really good situation with a massive red flag. Say your revenue grows at 10%, but your SG&A only grows at 4%. That is beautiful. That's positive operating leverage. The company is managing its overhead efficiently, and that SG&A ratio is going to drop. But flip that around. What if revenue grows at a modest 5%? But SG&A suddenly surges by 20%, that is a glaring, siren-blaring red flag. It tells you there is wasteful spending going on, or that corporate overhead is just completely spiraled out of control. Let's jump into part 3, cost behavior and leverage. Honestly, this is one of my favorite concepts to teach, mainly because it explains exactly how a company's expenses react when sales volume changes. We need to completely understand the difference between these 2 behaviors. Variable operating costs scale up and down directly with your sales volume. Remember those sales commissions and shipping costs we just talked about? Perfect examples. Fixed operating costs, however, stay completely flat regardless of volume, as long as you stay within a relevant range. A classic example here would be those corporate lease payments or fixed administrative salaries. Now, what's really fascinating here is that the proportion of those fixed operating costs actually dictates a company's degree of operating leverage, commonly known as DOL. DOL basically measures how sensitive your operating income is to changes in revenue. It's like a multiplier. The main formula you've got to lock down is the percentage change in operating income, which you might also see as EBIT, divided by the percentage change in sales revenue. But you know how the exam is. They love to test your flexibility, so you need to be armed for any variable they might throw your way. Here is your alternative DOL formula. You can also find DOL by taking the contribution margin and dividing it by the operating income. Please make sure you memorize both of these so you're never caught off guard on test day. The most crucial thing here isn't just knowing the formula. It's understanding what a high DOL actually means for a real business. A high DOL means a company has high fixed operating expenses. So when sales go up, operating income literally skyrockets. It's fantastic during a growth phase. But, and here is my critical warning for you, it is a massive double-edged sword. If sales decline even a little bit during an economic downturn, operating income crashes just as fast. Bottom line, a high DOL equals significantly higher operational risk. All right, part 4, CMA practice with Horizon Corp. Let's step away from all the theory for a second and dive into a classic CMA Part 2 analytical scenario. Let's put some real math to these concepts. Take a quick look at the raw numbers for our fictional company Horizon Corp across 2 years. Year 1, they pulled in $2 million in revenue, had $500,000 in SG&A, and ended up with $300,000 in operating income. By year 2, revenue jumped to $2.4 million, SG&A bumped up to $540,000, and operating income climbed all the way to $450,000. Just let those figures sink in for a second before we crunch the numbers. Don't worry, I am going to hold your hand through this entire process. To tackle an exam prompt exactly like this one, you just need to follow these 3 steps. Step 1, calculate the percentage changes for revenue, SG&A, and income. Step 2, calculate your degree of operating leverage. And step 3, interpret what the heck this actually means for the company's operational efficiency. Okay, step 1, let's look at the growth. Revenue went from $2 million to $2.4 million. That's a solid revenue growth of 20%. SG&A crept up from $500,000 to $540,000, which means SG&A growth is only 8%. But look at this. Operating income soared from $300,000 to $450,000, marking a massive 50% growth. Notice something really wonderful here? Their operating income growth completely blew their revenue growth out of the water. And that brings us to step 2, where we find our magic number, 2.5. We simply take that 50% change in operating income and divide it by the 20% change in revenue to get our DOL. So on to step 3, what does this tell us? It tells us Horizon is crushing it with operational efficiency. Their SG&A to sales ratio dropped, and thanks to that DOL of 2.5, every single 1% increase in sales turned into a 2.5% boost in their operating income. Now that is leverage. Finally, part 5, 3 golden exam rules. First off, congratulations on nailing that math. You are doing absolutely fantastic. Now, let's pivot to some insider secrets for navigating those tricky curveball exam questions. Because listen, any average analyst can read total expenses off a sheet, but as CMA, we evaluate the nuances. I want you to mentally screenshot these 3 golden rules for exam day. Rule 1, always watch out for improper expense capitalization. If routine maintenance suddenly gets capitalized as a fixed asset, SG&A drops and current profits look amazing. Think about the WorldCom scandal. That was literally their playbook. Rule 2, do not confuse operating leverage, which deals with fixed operating expenses like SG&A, with financial leverage, which deals with fixed financing costs like interest. Keep them separate. And Rule 3, always back out discretionary expenses to evaluate true sustainability. If a company shows a sudden massive profit spike, but you realize it only happened because management completely slashed R&D or advertising, they haven't become more efficient. They've just mortgaged their long-term competitive advantage. So as we wrap up today's explainer, I want to leave you with a bit of a provocative question to chew on. Are you analyzing expenses by just looking backward in time, like a traditional accountant? Or are you optimizing them, looking forward, to drive real strategic value, like a true CMA? Keep practicing those ratios, keep running those DOL problems, stay focused, trust the hard work you're putting into your prep, and I just know you are going to absolutely crush this exam. Catch you in the next one.